Oh, I got it. Here we go. Sorry about that. Hi, everybody. Welcome to the Tax Law Committee for the Suffolk Bar Association. Today we have a great panel. And before we introduce them and tell you about the great topic, I want to tell you about next month. I'm Karen Tenenbaum, Tenenbaum Law in Melville, New York. We handle IRS and New York State tax problems. And next month, December 9th, we're going to be having Jerry Wolf and Deborah Rosenberg speaking about the Secure Act and the shrunken stretch. So I hope you'll join us next month for that. Today, we're so lucky. We're going to be talking about mergers and acquisitions, how to grow a business that will sell for maximum value. We have three great speakers. We have Kyle Griffith, Ken Pischel, and Christine Malafi. Let me tell you about each of them. Kyle is the managing partner of the NYBB group. And for the past 18 years, that group has assisted privately held companies in need of merger and acquisition and business advisory services. Kyle is on the board of governors of the International Business Brokers Association and is the CEO and founder of M&A, an advisory network for business owners seeking to build, grow, or exit a company. Ken Pischel is the founder and managing member of Dynamic Business Consultants, a firm that provides consulting and business services with a concentration in financial and operational strategies for closely held businesses. It's located in Northport, and the firm services clients in the tri-state area. He's also a fractional CFO, and he has strategic business consultant and bookkeeping, assisting companies in both growth and crisis mode. Christine is an attorney. She's the senior partner and chairs the corporate department of Campolo Middleton, which is a Forbes recognized, which Forbes has recognized as a top corporate law firm in America. And it's the only Forbes rated corporate department on Long Island. She does mergers and acquisitions and general corporate work. And she's led this team doing countless deals, countless M&A deals worth billions of dollars. And with that, I'm going to let them share their screens and take it away. If you have any questions, you could put them in the chat box as we go or jump in. Take it away, guys.
Thank you very much, Karen. I feel really honored to be part of the presentation today. We have a distinguished panel. I just feel privileged and honored to be here alongside my good friend and colleague, Ken, as well as Christine Malafi, who's doing big things with Campolo Middleton. So awesome, really excited to be here. I think for our discussion today, we want to keep it engaging. So if you have a question, stop me, raise your hand, and I'll be happy to stop. And we have a nice group of folks here, and any questions you have, definitely reach out and stop me, right? So it's going to be more informative, but we want it to be engaging. So the three of us are going to present in different aspects of a company, from legal aspect, financial aspect, and from the M&A aspect. So today I'm going to talk about how to build a sellable company. We're going to talk a little bit about the marketplace and what to expect, whether you're looking to sell a company or even looking to grow a company with the plans of maybe selling in the future. We talk a little bit about that. And we're also going to get into business value drivers, which is one of my more exciting pieces of content to discuss. If you don't know us, I'll share a little bit of information about our company. So we are the NYBB group. I have two partners, 10 advisors total. It's 10 M&A advisors, and we have 12 consultants that make up our group. We are a lower mid-market M&A business advisory firm. We are based on Long Island, but we do have a national reach. We have clients across the U.S. Majority of our clients are here in the New York market area, in the tri-state area, because that's where we are based. We provide sell-side advisory services for companies looking to exit. We provide buy-side advisory services as well as business valuations, exit planning, consulting work, and we also are a commercial real estate company. That's a little bit about us. A little bit about myself. I've been an entrepreneur for 20 years. I've been in the M&A space for 11 plus years. I do have some credentials that I've kind of collected along the way. After a period of time, you have to figure out how you're going to fit all these designations in a card. Thank God there's no more business cards anymore, right? I'm heavily involved. I'm heavily involved with the International Business Brokers Association. If you're not aware, it's the The main association geared towards advisors that are looking to buy and sell companies. I've been recently re-elected to the board, and I'm going to be the chairperson of the IBBA, started in 2023. I also serve in the local New York board as well. So get into our content. So there are a lot of businesses in the US, right? Close to 32 million. There's about 2.2 million in the New York area from the last time when I pulled the stats. If this is off, to let me know. But essentially, there's a lot of small businesses, and from the surveys that we have done with the International Business Brokers Association, what we have learned is that 1 out of 5 businesses is thinking about selling their business. Right, so every 5 business owners you engage with, every 5 clients you have, 1 out of that 5, 20% is thinking about selling at some period of time. Now, since COVID, M&A activity has picked up a lot, and there's a lot of factors that has caused that. So, with COVID, it was a slowdown in 2020. It was a huge slowdown in the market. Not just us, but this is across the world, and especially here in the US. And now in 2021, we are seeing a lot of delayed sales. So companies that were scheduled to sell in 2020, they are now looking to be sold in 2021. One of the biggest issues we are seeing now for businesses that are thinking about selling is just the fear of the capital gains tax. That's the capital gains tax they have to pay in the sale of a company. One of the chief concerns right now is that the Biden administration, if they follow through in the campaign to increase capital gains taxes, it definitely can affect the net proceeds that a business owner can get when they sell their company. So we have seen a lot of companies in 21 just kind of racing to the finish line to get deals done. We had 2 closings this week and a couple more on the way, and I'm sure Christine has a bunch that she can talk about. But activity has been way up. I mean, PwC also has been monitoring M&A activity as well, and because of the slowdown in activity, M&A activity in 2020, there's a lot of cash available, right? What we call dry powder. A lot of money's available in the marketplace now to purchase companies. So you have the tax that's driving the sellers. You have the capital that's available in the marketplace, right? And business owners who wanted to retire. I mean, they've been through the first recession, the last recession in 08, 09, right? Now we had a COVID pandemic, right? A lot of business owners don't want to go through this again, right? And there are 10,000 baby boomers that are turning 65 every day. So between retirement, which is the number one reason why business owners sell their company, between the taxes, okay, and the access to capital from that the buyers have, it's a trifecta. So that's definitely driving the marketplace, and it's something that has kind of factored into what's happening now. Now let's talk about what's moving and what's not moving. This survey was taken from the second quarter of the Market Pulse survey. I serve in this committee with the IBBA, and we collect surveys from investment bankers, M&A advisors, and business brokers across the country. And from the survey here, it tells you which businesses buyers are looking at. So if your business falls in any one of these categories, it will be a hot commodity. Us with NYBB Group, and maybe I'm sure Ken and Christine can jump in here anytime. We've been doing a lot of industrial type of deals and have clients in those spaces, and it's pretty much consistent here. We do have a construction company, engineering company in the market. We have 2 manufacturing companies that we're representing right now. These numbers to the left are industry values, there's enterprise values. So companies that sell for between 1 to 50 million. This in the lower middle market space is the space where we focus on primarily. Industrial, manufacturing, construction, that's what's moving. I have a client that owns a metal distribution business, and he is just printing money right now. He's doing phenomenally well with the cost of metal going up. He's actually making more money now because his margins are factored into that cost. And now that there's more permits now for construction. His clients are buying more materials and there's more jobs. So that space is a great business, a great space to be in. Now, we spoke about the reasons earlier why sellers are going to market. Retirement has always stood out as the number one reason why sellers are exiting. They're burnt out. In a lot of cases, you have business owners that have been in their business for 20, 30 years, and their plan was, at some point their kids or even their employees would buy the business or take over the business. We're not seeing too many second and third generation companies. A lot of cases I've had clients where I've actually sent their kids to work elsewhere, go experience the work life with other companies and, come back. I think that's usually the best way, because kids that are forced in a company are usually not happy. I was representing a HVAC company, and Karen, let me know if I'm okay on time, okay? I go speed up if needed. I was representing an HVAC company, and he bought it from his dad, and he just feel obligated because it's a family business. He wanted to keep it going, and he came to me and said, "Hey, Kyle, I don't want to do this business. My heart is not into it. It's my family's business. I want to be in the financial services." And he went to start with a merit prize. But retirement is the key reason. You have folks that have health issues and other things, and they're burnt out. But retirement has been driving the sellers to go to market, for the most part. If you look at companies with values, enterprise values between 5 to 50 million, they have been getting a much higher valuation. Quite frankly, the larger the companies, less of them available, and they become much more attractive. When we spoke about the trifecta earlier, right? So if you look at this graph here, look at the far right, there's an orange column. That's first quarter 2001. Valuations is up 107%, and in comparison to previous quarters. So the larger companies are getting higher valuations. This graph here is much more easier to understand. If you look at companies with Ebitda between 2 to 5 million, if you look from right to left, there was a dip in 18, but second quarter 2021 is up 4.5%. So we're seeing values going up. If you look at the larger companies with enterprise value with Ebitda, between 5 to 50 million, multiples, and this is just an average, right? Between 5.5 to 5.8%. So we're seeing valuations going up, especially for the larger companies. And Christy, I'm sure you've probably seen this as well. Some of the deals that you're doing, we've seen a lot more, not a lot more, but earnouts are inching up a little bit more now. In the second quarter, if you look at the second column there, for companies with sale pricing 1 to 2 million, earnouts is 3%, whereas in I'm sorry, this is flipped here. So we were at 2% in 21 and 3% in 20. But if you look at the larger companies, earnout is at 11%. And the reason you had that 3% in the second quarter of 2020, that was a way for buyers essentially, well, sellers rather, to bridge the gap that's right in the middle of COVID. So that's what attributed to that increase, a 1% increase in earnout. But in the larger companies, 550 million, earnouts are up. I'm doing a deal right now where the business has not completely rebounded from COVID. Their numbers, they took a huge hit, and it looks like their business is going to come back. However, we're looking at doing an earnout to help them at least get that value back, get that sale price where they want to be at, but mitigate the risk on both sides for the buyer and for the seller. All right, so this is kind of summarizing like what we're seeing. This is information that came from Forbes. We are seeing multiples, as I mentioned, are going up, especially for larger deals. Buyers are willing to put more equity in transactions. We've seen a lot more higher down payments. I'm sure Christine has seen that as well. And there's been a huge trend for buy and build, right? As opposed to starting from scratch. We have had a lot of investors and financial buyers, we call them, that are, as opposed to buying a company and replacing ownership, they actually keeping the owners in place, buying out, let's say 70% equity in 70% equity in the company, and have the owner stay on and essentially get a second bite of the apple. So they'll essentially sell the business twice. They'll sell the business one time, retain some equity, and then sell it again after they improve the business. So you see a lot of those types of opportunities. I mentioned earlier about, second and third generation. 30% of businesses have seen a second generation transfer. This information, by the way, is from the Exit Plan Institute. Be happy to send anyone, these surveys so they can see the data for themselves. But what really stands out here, a lot of business owners have done little to no exit planning whatsoever. And I'm sure Ken can relate to that with a lot of his clients.
So Kyle, I'm just going to say we started
Sure.
a few minutes late, so you still have a few minutes more. But be mindful of the time.
Yeah, so I'm getting into the sweet spot here now, Karen. So we're gonna have a lot of fun going down the stretch here. So, you want to think about the end in mind, whether you're looking to exit or grow your business. You want to put together a good exit plan, right? You want to have that peace of mind, right? You want to know what you're going to get for your business and how you're going to get to that sale price, what you got to do now to improve the valuation of your company. And especially with the tax indications I mentioned, you want to make sure you're doing some great tax planning, which I know Karen can attest to. Okay. So let's jump into it here, and this part of it, I know Ken, you're going to touch on a lot of these items here, but you're welcome to interrupt or jump in. I didn't put the chart in here. I should have put it in here, but one of the surveys we asked buyers, what was one of the major factors you use when determining the purchase of your business? And, cash flow has been number one and always has been number one. Most people are not buying a hobby, so they're going to look at your cash flow, your earnings. They want to see, how profitable you are. So that definitely has been a big standout. As far as business value drivers, you could have two companies that generate 20 million in revenue and one has higher cash flow. Which one do you think is more profitable? The one that has the higher cash flow. So having good, clean financial statements is very important to any company. You want to make sure you can understand your numbers, you can create some projections, and just make life easier for you when you get putting your business on the market. I can't stress enough having a great team in place. You don't want to be the business owner that you're taking orders, you're cooking the food, you're washing the dishes, and you're doing the books and all that stuff. You want to have some infrastructure. I can't tell you how many times buyers ask me, okay, well, who's the key management? Who's going to stay in place, and who's going to go? You want to start building that out. So there's a lot of value in having a team, especially right now where there's a issue with finding good skilled workforce, good mechanics, good managers, good executive staff. It's hard to find good people. So having a good trained staff is important. Written policies, get the stuff out your head, get it, get that all documented. What happens when you have, when you have a new client, what's the new process, right? You want to have all of that, documented. Minimize risk. This is a big one. So there's three major things with buyers when they're looking for businesses and big value drivers. The three main ones. There's a lot on this list, but the first one's the profits. And another big one is minimizing risk, right? And an employee, you buy a company, a key employee leaving to start their own business, to be a competitor. I've had issues where key employees have sabotage deals because they're not happy with the buyer, don't like the offering or the benefits package you've been putting together. You want to get those stay agreements in place. Vendor relationships. Right now, there's issues with the supply chain, so having multiple vendors available and to supply your goods. So there's a lot of things you need to review. I'm
going to actually jump in here and say we're doing a seminar next week at the tax symposium about the tax situation. So people might not realize that there's a bulk sale filing requirement in New York State, that they might have transferee liability, that there might be payroll tax issues, sales tax issues, and they could be stepping into the shoes of some of these problems.
It's so much. It's so important to have good folks like Karen, Christine, Ken, and myself on this. You know, you need to put a team together to help you, because you're not going to know that. I mean, OSHA just put out there, I mean, it's official now as far as the mandate goes. There's a lot that you need to be up to date on, HR and compliance and so on. So yeah, you're definitely right. You know,
And so Kyle, you're going to have to also start wrapping up. I'm sorry.
Okay, so I'm gonna, so this is the bulk of the presentation here. Recurring revenue is key. A lot of buyers looking for some sort of subscription base, or customers that are coming back, long-term contracts, and scalability is a big one. So you make $20 million last year. That's great. How can we get to 40? How can we get to 50? You want to start with evaluation, just to see where you're at, just to see what you need to do to get to the point where you're ready for exit. It's very important. That evaluation involves, recasting your statements, determine the profitability of your business, and benchmarking you in comparison to the industry. All right, so it starts with determining the value of your business, getting an evaluation done so you can do some forecasting for where you need to be at. These are two deals that one is sold, one we're currently in the process. The first one, we spoke about Ebitda numbers and how they've been going up. In this case, this private equity group was doing a roll up, and they need to get their portfolio companies to a certain size that it can be sold. So we was privy to that in our negotiations to get them a premium price for their company. And then we have this engineering company in the market right now with multiple offers, with pretty good LOI, pretty good indication of value with pricing that my client likes a lot. That's a kind of, this is our team. We were a full team of advisors and to help clients in their needs, whether they're buying, selling, or need us advice and growing their company. So I'll turn it over to Ken, but thank you all, and thank you, Karen, for giving me the opportunity to speak. Ken, the floor is yours.
Right, before Ken goes, I want to just thank you so much, Kyle. That was really wonderful. I also want to give the code. It's 968S, 968S, in order to get your credits. So Ken, take it away.
You have to unmute yourself, Ken.
Thanks,
Okay, Ken,
Kyle.
you know how to share your screen?
Yeah, I'm doing that now. All right, see my screen?
Yes, I can.
All right.
Is there any way to get rid of what's on the left there? Nope, we just lost it. We lost your screen.
Oh, all right, I will move it back. I moved it to my big screen, I'm sorry.
Yeah, is there any way to start the slideshow from the beginning so you don't see what's on the left?
Oh.
Got to go to the top where it says slideshow. Keep going. Go to the right.
The middle, the
Go to
middle.
the right.
Yep,
Got it.
right there.
Yep, right there.
Good. Now
Keep
from
on
the
beginning.
beginning on the left, right? There you go. Perfect.
Got it. Thank
Except
you.
now, why do we see what's on the right there? We're not supposed to see that either.
Yeah.
This
I do
is
not
why I
know.
wanted you to do it. I don't.
It's okay. We won't pay attention to it.
Go ahead, go for it.
All
We'll
right.
watch it. Go ahead.
All right. So anyway, I'm going to talk about maximizing value in your business, which I think Kyle touched on quite a bit at the end of his presentation. So we'll dovetail into that a little bit about dynamic business consultants and myself. I've been functioning as a fractional CFO for the last 13 years, working with companies to help prep them for sale, kick the tires for buyers, and then just helping companies in distress, turning them around, as well as young companies and helping them grow in a scalable manner, and to hit their end goals. So, the idea is to be efficient operationally as well as financially. As they do dovetail and go hand in hand. We also handle the bookkeeping for a number of companies from an outsourced perspective, so they can actually get the clean books, the reporting, and be in a position where when a buyer comes in, you have something real to look at and can back it up. So with that, Kyle started to touch on this, business value maximizers. Depending on the industry and the buyer's strengths and appetite, you know, the value is going to be different, you know, in each case. But sales, types of sales, maturation of industry, because you could be an industry that's shrinking even though you're doing well, and the buyer might not see such an opportunity, or at least a limited opportunity. Ebitda, assets, types of assets, liabilities, types of liabilities, business equity, and then minimizing the risk factors, operational expertise, and human capital. I'm going to start and speak about the sales. I think Kyle mentioned this. Recurring revenue, number one and everybody's favorite, because you always know what you can count on. So any business that has that, I'm sure is going to fetch a higher price. Next on that list would be contract revenue. Contracts are secure. You know how long you can count on something. If it's been renewed over a bunch of years, you can almost bank on it continuing to be renewed as long as there are no major changes. You know, and then from there we have project revenue. B2B sales as opposed to B2C sales. I think B2B sales has a little bit more value in most cases, unless it's retail oriented. I think B2C sales and service based, you have a lot more defaults, you know, if you're not getting paid up front. So there's a little bit more risk there. And customer concentration. You know, I could have two companies that are doing $25 million in sales. One company's largest customer gives them $2 or $3 million a year. One company's largest customer gives them $10 million a year. Well, what happens if that one company loses that $10 million customer? It's a big deal compared to if the other company just loses their $2 or $3 million customer. So customer concentration is huge. Not all sales revenue are equal. This is what I'm trying to say. And then again, projected market growth or decline of a product or service, and that's what I started to touch on, is you could be in an industry that's growing and have a small slice of the pie, and that could be a lot more valuable than an industry that's shrinking, where you have a large slice of the pie. And you know, there are many products out there that we remember growing up that no longer exist. So you have to know where your value is and where your market is, and adjust and adapt. And some of those companies just don't, and that will lower your value if you're not able to do that. Ebitda, so earnings before income tax, depreciation, and amortization. Probably the most important factor these days, especially after seeing what Kyle had to say. What comprises Ebitda? It's sales, it's less your cost of goods sold, which is a direct cost, which will give you your gross profit. From there, you can derive your gross margin. So your gross margin is really your sales minus your cost of goods sold. And then the difference there divided into your sales will be your gross margin. And then, of course, we have office overhead. And depending on your industry, there are a lot of different metrics on what your gross margin should be and what your office overhead should be, as you always want to measure your office overhead as a percentage to sales. Again, that number will change based on the industry. Now, we have assets equals liabilities plus equity. There's the finance person in me. All right. Assets, let's go over that. We all know the value of cash. Cash is king. Accounts receivable. Well, accounts receivable are great, depending on where they're coming from and how long they've been sitting there. So if we have accounts receivable that's turning over every 30, 45, at the very least, at the very worst, 60 days, we're in good shape. And again, that customer concentration on the accounts receivable is something that has to be factored in too. We have accounts receivable that's lagging out there 90 days, 120 days. We have stuff sitting on the aging from 2018 that never got written off, and it said, oh, we're in dispute, we're gonna get that money, we're gonna do this, we're gonna do that. Buyers don't care. I mean, this is what I hear from the owners, that they insist they're going to get their money. They're not ready, but the buyers don't care. Clean it up, move on, make it look good. Equipment, another asset, depending on your industry. It could have a lot of value. Sometimes there's redundancy, but then you can sell the equipment if it has some value. Other times, your seller might have equipment that's going to enhance the buyer's position and improve their operations and increase capacities and lower their costs of goods sold. So that's always important. Real estate is very important too. You could be looking for certain distribution outlets. It could be you want to open up an office in a different market. Real estate has value. So, and then of course there's intellectual property. And intellectual property could be anything from the name and the brand, it's trademarked, to copyrights, or it could be, I would say it could be something that's patented, technologies, again, brands, so products, so there's a lot of value there. Now we have our liabilities, our accounts payable. Well, how current are we, and how are our relationships with our vendors? What are our credit terms? Do we have disputes going on? Again, that's the flip side. We could have payables sitting there from, again, 2018, and they just refuse to acknowledge that they owe. The seller refuses to acknowledge that they owe the money. Well, you know what? At some point, you need to settle that, because no buyer wants a potential collections problem or a lawsuit, and it's got to be clean. And then there are reps and warranties on the seller side as well. So if the seller says they don't owe it, and all of a sudden it comes back, well, guess what? The seller's going to have to pay it personally at that point. So, we can go, and from there we go down to debt. Credit cards, loans, leases, lines of credit. All of that needs to be cleaned up. I mean, sometimes there might be certain equipment leases that you want to try to assume. I'm sure the loans and or term loans or things of that nature, if they are assumable. But all of the details as to what happens to that debt need to be, we need to know if it can be worked out, how it's going to be worked out, because that can affect the value of the company tremendously. Payroll taxes, another big thing. I have too many clients who have prior payroll tax problems before my watch. These things need to be cleaned up. And again, there's personal liability to the seller on the payroll taxes. Same thing with 401k liabilities. You need to make sure that when you're taking those contributions out of your employees' paychecks, that they're actually getting, to your fund administrator, and that there's that nobody owes any contributions to the 401k plan. And then we have the equity side, retained earnings. Okay, that is retained earnings, and equity is the lifetime value of your company. And sorry, I just hit. So retained earnings is the lifetime value of your company. All the money you've made, all the money you've lost, less what you've taken out of it. And what you've taken out of it is always something that gets looked at very closely, because too many owners treat their businesses as a personal piggy bank. And they do everything they can to not show that profit, keep that Ebitda down. And that's going to lower the value of your company. So if you're looking to sell and you're looking to build value, you need to leave the profit in and pay the tax. So, and through it all, everything I've talked about here needs to be documented. Record keeping is, the record keeping is crucial. You need to have paper trails to every report and every number that you're showing. Now, where is the risk? All right, human resources. Well, potential employee lawsuits, huge potential risk. All right, you want to make sure that you're buttoned down in your HR policies, that you're compliant in every way. That you're running your business as your handbook states, and that hopefully you have a handbook, because I run into that too many times, where I get handed a standard operating procedure booklet that's about 12 pages, and they say, this is our handbook. That's not a handbook.
Can I see this? Jeanette, you want to unmute yourself and ask your question? Jeanette. She says, what if two law firms of fairly comparable value merge? Just throwing that in the middle of this.
Hi, sorry. I'm doing too many things at once. Well, I didn't want to interrupt what you were saying, so that's why I was typing, but I didn't finish the sentence.
Oh, I'm sorry.
Yeah, basically, doesn't it make most sense basically to close the other firms, close the books, finish each one separately and start afresh, as opposed to taking on all that weight on both sides?
I think I think it really depends on what the weight is. If there are liabilities that are going to follow each of the partners personally, whether you open or close, whether you stay open, you stay closed, you might as well try to merge it and stay open, so whatever liabilities are in the company can be paid out. Because the first thing you have to figure out is, how are those liabilities going to get satisfied? And if we don't satisfy them from a firm perspective, it's going to follow me personally. So now I'm going to have to pay for that. Not every liability has a personal guarantee either, but the ones that do. And okay, so now I'm going to have to pay for that. So now you have to figure out, well, how does that affect the value of me merging?
Right,
So,
but assuming both are successful, viable practices, that usually can get cleaned up. It's usually not an ongoing liability.
Right, which would be more cleaned up in regards to what? Are you talking about vendors?
I'm talking about cleaning up any liability debt-wise, cleaning up your current client load yourself to the extent that you can. Timing's an issue, and if that can't be done because a case is going on, basically signing up the client with the new firm that they choose.
There needs to be enough cash to clean up the liabilities.
Right.
So it really comes down to how much cash do you have against what your liabilities are.
Right.
And also, I'll just butt in for a second. Also, if the substantial assets from one practice are going to another practice, the liabilities are going to follow that. You don't cut it off by moving it.
Correct.
So it's successor liability a lot of times. It depends. It's very fact specific, but it's not very easy to take the assets of one business and move substantially all of them to another business, but yet leave all of the liabilities behind the law. Not when it comes to finance debt. It's very, very difficult. Right.
I mean, sometimes you can get away with that with large vendor debt. I guess if you do a bulk sale notification and assets, but that's a whole different thing.
Right.
Okay. So Ken, you're gonna have to start wrapping up so we could leave time for Christine as well.
So real quick, your risks, human resources, keep them all buttoned down, keep them tight. Don't get yourself into trouble. All right. Contracts, the same thing. Make sure you know what your contracts state. Assignability clauses, if you're looking to sell, are huge. So understand that. Insurances, make sure that you're protecting yourself against from a liability standpoint, both from an outside risks and internal risks. All right, accounts receivable, accounts payable, I've already addressed, so I'll skip the rest of that. Operational expertise, a way of value. All right, scalable systems that are efficient and secure. Technologies that improve speed, output, and increase labor capacities. It could be through software, different types of softwares, consistent workflow processes that are documented that produce consistent results, and showing that you have expertise in project management, production, logistics, distribution channels, maintaining the data to verify these operational efficiencies is crucial because it does have tremendous value depending on what the buyer is looking for. All right, human capital. All right, all of those technologies and processes don't work without good human capital. Kyle touched on this, key personnel and management. In your sales, your operations, your finance, people that are going to stay on and help guide the ship once the sale is done. If the business revolves around the owner, there's not going to be that much value. You need these people and you need these processes because the people need to drive the processes. All right, if we fail to maximize our value, when we don't do these things, we have lower purchase prices, less cash up front and more earnouts, more deal contingencies, possible asset sale, which I just mentioned when Christine was speaking, instead of an entity sale, and more personal risk in your deal covenants, which I briefly alluded to. All right, and your summary. What you need, you want revenue consistencies, maximizing your Ebitda, build your assets, minimize your liabilities, build your equity. Have smart contracts, smart culture, keep compliant, no shortcuts, efficient operations, and have good people. And I'm good.
Thank you, Ken. Again, the code is 968S. And now we're going to unshare Ken's screen and we're going to allow Christine to share hers. Ken, you got to hit the button on the bottom.
I'm going to unshare. I'm stopping now. All right.
Perfect.
Okay.
Yep.
Great talks, guys. Okay, let me share my screen now. Okay. Hi, everyone. I'm going to do this on a very shortened scale because I see I don't want to go over too much. The Kyle and Ken were totally spot on in everything that they said. I'm going to try to just touch on not the very specifics of, but just the things that you have to think about from a tax perspective when you're setting up your business to sell, some of which require years in advance notice to do, and others which is as you go along. What type of sale are you going to do? How are you going to work everything? And everything that I'm going to say depends upon all of the points that Kyle and Ken made with respect to how things are calculated, how you set things up, how you put the deal together. So hopefully this helps. If there's any questions, let me know. Let me see. Nope. Yep. Okay. So first, the type of taxes that you're going to pay depends upon what type of business is being sold. So are you a sole proprietorship? Are you a partnership? Which are basically the two types of businesses that don't require any filings with the state other than name filings. And just in general, a sole proprietorship, if you sell, usually you're going to have capital gains taxes. Depending on the business, inventory might be subject to ordinary income tax rates, but you should definitely check with your tax advisor to set up your inventory versus assets versus how you're going to set up for a sale. Beforehand, you might want to change from a sole proprietorship to another form of business that we'll talk about in a few minutes. Partnership, same thing. A sale of a partnership interest is treated as an asset sale. And the partner share of the unrealized receivables or inventory will be subject to ordinary income tax, just in general. So it also depends if you're a C Corp versus an S Corp. So a C Corp is taxed as its own entity. It's its own person. It has its own tax ID number. And it has to file its own income tax returns. So whether or not you do a stock sale or a membership sale versus an asset sale is more critical when you're a C Corp than when you're an S Corp. And we'll get into the reasons why on an S Corp. But for C corporations, the owners of a C Corp usually face double taxation. The corporation is taxed on income, and then the shareholders are taxed on income when they take money out of the corporation. Stock sale proceeds are taxed at capital gains rates, and asset sales are usually taxed at ordinary corporate income rates. So that is a big deal for a lot of sellers. And in order to set up a transaction to best work for the seller, you want it to be a stock sale, and usually best way for the buyer is an asset sale. So there's a lot of things that you need to set up, and it's very important that you talk to your tax advisors and your attorneys as you go along, as you're trying to sell a business. I'm just going to skip through. If anyone has a question, just let me know, because I'm going to kind of skip through so I don't take up, another half an hour. I think Dan. For S Corps, a stock sale is sorry, you know what's happening? Sorry, the pictures are clogging up the words. Wait, so let me see where I am. Okay, so for an S Corp, a stock sale is treated so you can, sorry. So a stock sale is better for the seller, but an asset sale is better for the buyer because they buy at a higher, they get a, what is it? Sorry, it's escaping me.
Pictures could be moved. If you put your mouse over the pictures, the whole thing can be moved. I just tried it.
Oh,
Put it at the top.
Okay. Yeah, you can move those out of your way.
Yeah.
Okay. Well, I have the thing, so.
I was
So
playing
it's-
chairs before you guys came on too. I was moving things all over the place.
Yeah, you can move it.
I can't, yeah, sorry about that.
Not
So
a problem.
basically, a stock sale is better for the seller, but an asset sale is usually better for a buyer because they get a stepped up basis in the assets. So it's better from a tax perspective. But there's ways, if you set it up in advance with the buyer, that you can sell the stock of an S corporation, but the buyer you make an election so that it is treated as an asset purchase from the buyer's perspective, but not from the seller's perspective. And then usually, that's usually what you wind up doing. And you can do it, minimize the stocks, but you cannot, you can't just do this on the fly. Everything has to be spoken to with your buyer or with your seller in advance so that everyone can set up everything as they need to set it up to maximize the tax benefits, but you need to set it up in advance.
Christine, I have a quick question.
Sure.
How does the IRS account for the liabilities in that case? If when the seller is treating it one way and the buyer is treating it a different way?
They're each going to file, of course, separate tax returns, but it's treated as a stock sale correct me if I'm wrong, Karen, it's treated as a stock sale from the seller's perspective, but from the buyer's perspective, it's treated as an asset purchase. So, and in any purchase of a business, it's very rare that the liabilities are purchased as well. Most of the time, the liabilities are paid off before the closing, so the buyer is not taking on the liabilities. So the liabilities being paid off come right off the top for the seller. Karen, you agree?
You're the pro in this area.
So, but I
handle the tax problems when they're a problem.
Yep.
You handle the planning.
Right. So it's just for this particular 15 minutes is just that there are differences and there are ways to set things up, but it's very important that a business owner set up their business to be sold in advance and think about all these things so that they know when they go out to market what they're going to look for and what to expect a buyer to be asking, especially in today's market, because you're both correct. I mean, the market is so hot right now. It's making up for lost time from COVID. And on top of that, with the possibility of capital gains taxes changing in the new year at some point, people are really hot to push. Private equity is really trying to push things along to close before the end of the year. So this is all the same thing. So if you are a C Corp and you say, you know what, I want to make sure I'm not doubly taxed when I'm selling my company, so I'm going to file to be an S Corp, you can do that. That's fine. But it's sort of like Medicaid look back. You can't do that you have to do that well in advance. So 5 years before you're going to sell, you need to change over to an S Corp. S Corp stat is like having it removes that second layer of taxation, and there are limits when you change to an S Corp as to who can be a stockholder and how many stockholders you can have. But for a lot of companies, it really works to change that. So if you know that you're going to retire and you want to retire in 10 years and sell your business, now's the time to set it up so that when you sell, you're not doubly taxed. But you really do have to do that now. Okay, I'm just going to redo. So what are you going to do? You're going to talk to your tax advisors, your lawyers, your tax advisors, your business broker. You're going to talk about what's the effect of buying a business and getting a stepped up basis in the assets, or staying with the seller's basis in the assets. You're going to talk about all of these things. A lot of them reduce the buyer's tax liability, and an educated buyer is the best. They're the best clients to deal with because they know what they want and they're not going to be talked out of it and then wind up having remorse at the end of a transaction because they didn't do all that they could to minimize their own taxes. Let's see. I'm just going to go a little fast. So if the seller has net operating losses, I got to look for my page, gains from a sale might be offset, resulting in reduced income tax at the corporate level. So it's true in an asset sale. So it's very important to look at all this before you put your company out to market or as you're getting ready to put it out to market. In other words, when assets are sold, ordinary corporate income tax can be mitigated by net operating losses. So you want to try to balance it out. We already talked about this. Gains, when you have gains on the sale of an S corporation, they're not subject to the additional Medicare tax that C corporations are subject to. And that could be a huge number. 3.8% is a lot of money always, but our average deal this year has doubled the value of it. We have companies selling for more than they ever thought they were going to sell for. Part of it is because of the hot real estate market for industrial real estate. So we've had clients who, if they have industrial space, people are paying double what they thought they were going to get for the business just so that the buyer can get the real estate. So that's true today, but under new tax laws, things change. So people don't want to take a chance in the current climate that it's going to get better. They think that tax-wise, it's not going to be better on the bigger deals. So you should talk to I keep saying it over and over again, but you have to talk to your attorney and your tax advisor as you're setting things up. Okay, let's see. The next thing is possibly deferring the purchase price. So a lot of times, as we're talking about with earnouts, a lot of times, depending on how you file when the transaction is closed, can make a big difference as to whether your full payment price is recognizable at the time of a sale or over time, and when the taxes are due on that. So it's very important that you talk about it with your tax advisors as you move on, and as a buyer talks about potential earnouts, potential payment of the purchase price over time. It may not be appropriate all the time, and the seller will pay income tax as the gain is realized at the then current tax rate. So a lot of sellers with more advanced tax advisors will know, is it better for me to recognize it now or wait a year? What's going to happen with the tax rates? So it's very important. If a transaction is structured as an installment sale, the seller will pay taxes long-term, which is better. But the question is, sometimes earnouts can be treated as installment sales and sometimes they can't. It's very specific, and you need your tax advisors there from the beginning. And part of doing this is to issue spots that you know as a business owner how to protect what you're going to, your return on your investment, because that's really what your business is. A return on your investment, and you want to maximize your return. And the only way to do that is to make sure that you have your ducks in a line and talk to your tax advisors as you go along. Only capital assets are eligible for installment treatment. So if you allocate too much to goodwill when you're selling your company, you're going to wind up paying more taxes. So what do you want to think about? If you're getting all cash at closing, what are you, the gain is going to be subject to income tax, whether or not it is assets or stock sale. You want to look at the equity. What equity do you have in the business that you're selling? It may be tax-free, tax deferred. You have to see how you can take advantage of these benefits. Sometimes there's ways to set it up so that if it's going to be a stock exchange, you do a stock exchange between the seller and a buyer, and you can organize it as a corporate reorganization, create another company, put the assets in the other company, each own part of the other company. We've been doing that a lot more joint venture-y. So I'm selling you my company, you're going to run it, but we're creating another company and I'm going to own a minority share in that other company. It really works. Sometimes it seems a little muddled, but it's not. It helps with taxes and it helps with down the line. Instead of getting an earnout, I have an investment, which is taxed differently. You have to watch very carefully, as Ken and Kyle had said, when you're buying assets of a company, you say, okay, I don't want to buy your stocks, I don't want to buy your liability. But it's not always true that by buying the assets that you avoid potential liabilities that go along with the company. Because if you buy substantially all the assets of a company, you will, under the law, have successor liability in all probability for some of those debts. So one thing that, as I think Ken just said, one of the major risks that you have is on employment issues, because employment issues do not go away. If there's wage and hour violations, they do not go away under any set of circumstance. The Department of Labor, the tax department will always follow the assets to determine where they can try to make employees who have not been paid whole. So it's very important. You can't just say, I'm buying the assets, I don't have to worry about the liabilities. You still buy, if you're buying substantially all of the assets of a company, you have to do the same diligence and background check that you would do if you were buying the actual stock of a company. It's very important. And the latest, and something else is the sales tax. So if you have a company that's doing business in more than one state, but is not paying sales tax in all those states, you need to hire an accounting firm or a sales tax firm that can go through and make sure that there's not outstanding taxes that have not been paid.
Right, that's where I come in. That's exactly what I do, handle those problems.
It's very important. I had a deal a couple of years ago where the buyer insisted that there was about $5 million in state sales taxes that weren't being paid in various other states. And my clients insisted, no, we don't hit the nexus, we don't have nexus, we don't hit the minimums, blah, blah, blah. All of these back and forth. And it went from 3 million down to, I think it was about 800,000, which is a huge difference, but it took a lot of work to get it down from the 3 million to the 800,000 with voluntary disclosures and working it out. So it's very important. You can't just walk away. Buying the assets is not the way to avoid having liabilities that go with the assets.
So we once had a situation, talk about bulk sales. So you really have to follow the forms and file it appropriately. And we once had somebody come in and they were buying a business. They knew that there was sales tax due. They went to New York State and they said, how much does this other company owe? And the New York State said $10,000. The guy wrote out a check, got a receipt from New York State for $10,000. And then it turned out New York State made a mistake. But the guy never filed all the bulk sale appropriate forms. And he ended up owing $100,000. He showed up at my door saying, oh my God, I made a mistake. What do I do now? And we were able to negotiate a deal for him. But you don't want to be in that position. No. New York State would have come in, told him the correct amount, and he could have dealt with it up front instead of this way.
Right. Yeah, you do. You have to be careful. It's not okay just to take the word of New York State, because if they make a mistake, they don't care. They won't say, well, you relied on the number we told you. They'll be like, nope, we made a mistake. Tough luck on you. And you're sitting there, oh my God. And good tax advisors will tell you, no, that number can't be right. Pay it, but no, you're going to owe X amount more. The last time I had to do this Wayfair analysis on sales tax for a company, the tax advisors, and I'm sure Karen does this as well, they know, oh wait, that state's going to have a special, a sales special, fire sale, that if you report, next year for these 6 months, you don't have to pay the penalties, and they encourage it, and they, you can get away with paying less, but it doesn't mean that you don't have to pay it. And you have to be very careful, because your deal documents are extremely important. If you buy the assets of a company and don't get reps and warranties from the seller, and don't get indemnification, then you could be wind up holding the bag, and you can't even sue the seller because they didn't agree. They sold you everything and you should have looked at it. So you have to be very careful. It's very important that you talk to your lawyers and get everything and that you hire the right people to do the right review of the business before you buy.
Well, I don't know. I know Connecticut is having a tax amnesty. I didn't read the specifics to see which taxes it applies to, but it just started, and everyone should be aware that Connecticut now has an amnesty for a short period of time.
That's really good. So, and there's also when you're selling your business, or when you're planning to sell your business, you have to remember, it's not just about the taxes or the corporate end of it. It's also, this is your estate, and you have to understand that it affects, a lot of times in family businesses, it's really important, because, I'll get a client who says, I have 3 sons. One of them is, wants to help me take over the business. So I want to make sure he has the business. And then it's funny, I would say at least 50% of them, you say, well, what about your other kids? And they said, well, they don't work in the business. And I say, okay, but when you pass on, where's your estate going? And they say, oh, to all my kids. And I say, well, how are you working this then? Because you can't give your business to one child and then you have nothing to leave the rest of them. So it's very important that nothing is done in a vacuum. Nothing is done, in a cone. You have to look at everything all together. So it's very important that when you have someone looking to buy or sell a business, that you look at, what do you do before, what do you do during, and what do you do after? And the estate part of it, and I don't even do estate work, but it's very important for people, because the end result is going to affect not just usually the owner of a company, it affects their whole family. So there are different ways to do trusts and how the funds flow and make everything liquid. That really helps. So, especially depending on the size of a transaction, I will always tell a client, not only do you want to look at the tax benefit, the tax implications to yourself and how to protect it, but remember, the whole reason you're doing this is to retire and have an estate, really. So these are all important things for owners of businesses, and people who want to buy them have to think about. And I think that I covered just the things that you have to just generally look at. I will just tack on really quick to what Kyle and Ken said. This is a seller's market right now, and it is really going hot. It's definitely going to stay this way until at least the end of the year. I would estimate probably into at least the first quarter of 2022. And I have buyers who are prepared to sell, are getting better returns and better equity in their buyer, so that everyone wins if the business continues to grow, rather than earnouts. That's what I see as the latest thing that sellers are doing.
That's great. So do me a favor. First of all, that was great. Thank you so much. I actually learned so much from your presentation, even though I'm a tax attorney. I used to do a lot of these deals. Oh, good. Keep that up for a minute. I used to do a lot of these deals, and now I handle the problems as they occur. So it's great to see, the before, the during, and the after planning piece. So I was just going to ask you, if everyone could just tell us how we could reach you if we need your help. So Christine, say out loud all this information that's on the screen.
Okay, so you can get me by email, cmalafi, CMALAFI @cmmllp.com. You can call me 631-738-9100. Always willing to just answer any questions, help anybody along. talk to you now, and, you're not a client for another 5 years when you sell your business, whatever you need. We're always here for everyone. We're a medium-sized business, and we understand what it's like to be a small, medium, and getting into large business. We do deals everywhere from, I just did a buyout it was 225 million. And it was a combination of real estate and other businesses switching around. And it was very complicated. We do everything from the extremely complicated to the extremely simple. And everyone is treated the same because everyone's business is their major asset.
That was great. Okay, thanks. And unshare your screen. Ken, tell us how we could reach you.
Well, I can be reached at kpischel@gmail.com or at 631-834-7919. And that's for any buyer who's looking to kick the tires and understand what's going on in the potential business that they're looking at. Or if it's a seller who needs someone to help them get prepped and ready and maximize their value.
Great. And Kyle, give us, your contact information.
Yeah, thank you, Karen. Yeah, so you can reach me at my website, which is the NYBBgroup.com. That's THENYBB group.com. And anyone that needs assistance with exiting or growing a company, we take that investment banking approach and we bring it to low mid market. Our clients are revenues up to 100 million. Thank you very much.
Okay, this was a wonderful panel. If you ever want to reach me, I'm Karen Tenenbaum, Tenenbaum Law. The number here is 631-465-5000. And you could email me at ktenenbaum, TENENBAUM, at litaxattorney.com or tax helpline at litaxattorney.com. Next month on December 9th, we're going to be doing a lot of estate planning and hearing from Jerry Wolf and Deborah Rosenberg. And again, the code is 968S. Thank you all. This was really wonderful. And we'll invite you back for the Suffolk Academy in the next year. Thanks again, everybody.
Thank you, everybody.
Thanks, everybody.
Thank you.
Bye.